Earlier today, Alice had asked me a question about Apple. She had emailed in and then she called and talked to Ernie, actually, and then she had sent me another question. And Apple went down about 4%, then was only down about 2.8, then went to 3.5% down. And she said, with the pullback, I'm considering a call to buy on Apple. And my concern was that she was looking to buy a call today based on the dip, or trying to buy a call or a put to sort of chase the stock down for an individual performance, for a daily performance. Okay, well, the first step is what happened today. Let me go to a 5-day chart. Let's go to 15-minute. Might not be the best selection. Essentially, at this time, at around 10:30, 11 o'clock this morning, that ruling came out. That was about there, 10:30, 11 o'clock this morning. The ruling came out for the Fortnite lawsuit against Apple related to the proprietary app purchasing. Now, what do I mean by that? Apple apparently doesn't allow third-party payments. So if you wanted to buy Fortnite on an iPad, if you wanted to buy Roblox, you wanted to buy Spotify on an Apple device, you're paying Apple, and then they get money later. What they wanted to do is say, no, why don't you pay me directly? It's more complicated than that, but essentially what it comes down to was that. Lawsuit came out and said that, yeah, the judge felt that it's not fair, that Apple can do that. So they said that you should open up, you have 90 days, I believe, to do it, to open up third-party payments directly to the third party on your app store. So this is a negative to Apple. And of course, it was a positive. Spotify, Roblox, Fortnite, I believe, is Epic. I don't know. I don't think they're optional, but EPIC. They moved up the 3 to 4% that Apple moved down today based on the ruling of this adjustment. Now, first email I saw from Alice was here. And, she had said, hey, Apple's pulling back, and I want to look for a call or a put to buy to take advantage of the movement. Well, the problem is at this point, yeah, it came back up a little bit and then it fell back down. But you're still in this wheelhouse of 150.50 to 149. Trying to profit on a 1-day call or 2-day call as you're getting closer to expiration and time is winding down is very difficult. After this move, you saw about all that those stocks were going to do. Yeah, there was some quick movement up here and some quick movement down. You might have made some small profit, but it's going to be very difficult to make a reasonable profit after this has already happened with just little movements. Hey, there's some buying here, but then, okay, we're going back down. What I was telling Alice is that you don't want to consider trying to day trade an option, especially after the event had happened. If you had bought yesterday a put option at the 154, 155 at the money strike, hoping or expecting that the ruling was going to come out today and it was going to be negative to Apple, you would have been looking at some pretty good profits on this position. But you had to be positioned before the known event. Trying to position yourself now for a 1 or 2 hour profit after the event has happened is very risky. But now that I think that Apple's pulled back, maybe Alice is thinking now it's at a buy point on the position. What tools and power options can I use to see which call option or put option will give me the best return? Well, let's say Alice's stance is this pullback was a good relief or easing for Apple, but it's Apple and it's still going to want to come back up in price. What if I expect in 2 weeks it's going to be back to that 154, 155 range from where it is right now? This is where we would use what's called the long option finder. You may be used to looking to buy a call on a position and looking at the option chain, and based on your speculation, you say, you know what, I want to be a little bit in the money, 60 days out of time, maybe a delta for James of 0.6 or 0.7. Because if the stock doesn't move up that much, at least I have a higher delta now. So if the stock moves up 1 point, I'm getting 70 cents. Or if you think the stock's going to jump 5 or 6 points in the next 10 days, you say, maybe I want to maximize profit. I want to use a delta of 0.3. Well, that's very speculative. And you could see that option go to 0 or significant loss. It's only going to be 40 or 50 cents in that case, maybe to buy. But if Apple doesn't move in the first 3 or 4 days and it's just sitting there stagnating, that 40 or 50 cents with the theta for only 7 days, here we go, 0.33 delta. I'm sorry, 0.17 delta here on Apple, the 155 strike at about 70 cents. Now you have 17% delta. The 30 delta is at 124. That 0.6 delta I mentioned, we're looking at 380 at the 147. at the money is always delta of 0.5. That's where we are at the 149. So James, when you asked me about delta and you said, what is there a proper delta to buy a call? Better than that is to use the long option finder. Because if you're looking to buy a call on a stock, James, or Alice, or a put even, it's because you have an expectation of what the stock's going to do next. Maybe, as I mentioned, Alice thinks that Apple could go back up to 155 by the end of the next week as the ruling of this judge settlement. I'm pretty sure Apple's going to appeal this position if they can. I didn't see which court we were in, but I'm pretty sure they can appeal this one. So I think Apple's going to go back up to 155. I'm going to put in $500, $600 into call options. I'm going to increase that. Let me go up to 800. And I think this is going to happen next week sometime. Let's say later. Let's say the 20th. I think it's going to take a week or maybe a little bit longer, but we'll be back up to 155. What this tool did is what you might do individually, James, on an option chain, but it did it for you. Not looking at delta, it simply said, look, if I think Apple's going to be at 155 on September 20th, that this was an overreaction, which call would give me the best theoretical return if the stock does hit near my target price on my target date? And Alice, if your thought was that Apple could go back up to 150, 155 in the next 7 to 10 days, or by September 20th, 10 days from now, this is showing you the best calls, what would give you the best return if the stock did hit your target price. It's showing us the 150 call currently right now at 284. With my $750 amount, I could buy 2 contracts. And the call be estimated on September 20th, my September 24th 150 call, the estimated value is 531. Is that reasonable? Yeah, it's 5 points in the money because we expected it to be at 155. 30 cents of time value for 7 days, that's reasonable. So this is likely what we would expect to see, an 87% return if Apple goes back up to 155. That's only a 6-point movement, right? We're only talking about a 6-point movement on a $155 stock. So percentage-wise, let's talk about this for a minute. That's very small, isn't it? It's a 3.8% move, almost gaining back, of course, what we lost today, being it down 3.6%. Now, what is the delta of the 150 call right now? It's probably 0.51. We saw that on the chain for the September 24th too, James. It's at the money, it's 0.15. Does this mean it's always best to buy the at the money option? No. What if your expectation was that we could gain, let's just give it 15 points. Okay, let's go up to 163 from where we are now at 149 roughly. Is the 150 call still going to be the best one to buy and give us the best bang for the buck? No, it's the 160 call. It probably right now has a delta of 0.13 because we expected a bigger move. Premium's only at 52 cents, 14, we could buy 14 contracts. And if Apple went up to 163 on September 20th, would my September 24th call be roughly around 389? $3 in the money. Sudden movement on the stock price. 4 or 5 days to go to expiration. So sometime value of 80 cents might be a little bit higher. But again, that's what we'd expect to see. Maybe if it's only 350, that's still the best bang for the buck as far as monetary return. So James, most investors who buy calls, if you're thinking about, James, buying calls that are a year out in time, 6 months out in time to do as a diagonal calendar spread perhaps, in general, I look for a delta of greater than 0.6 or 0.7 because I'm using that as stock replacement. If you're looking to buy a call 2 weeks, 3 weeks out in time because you feel a stock is going to move up in price 10 to 15 days, depending on your expectation to move, again, this delta is probably at 0.25, 0.3. It shows us the implied volatility. Whereas if I only expected that 3.8% move, the delta of 0.5 gives me the best return. It depends on the percentage increase or decrease. Now for Alice too, using the long option finder, if you thought Apple's going to continue down because they're going to lose money based on the apps that they have to change in 90 days and give third-party payments directly rather than taking a bigger cut that they're doing now or however they're doing it, but you thought Apple was going to continue down to 135, just put that in. And what is it going to show you now? It's going to show you which puts would give you the best bang for your buck for your expectation. During our conversation, Alice, I had mentioned that you might want to be looking for December or January calls to have the stock move more in your desired direction. Well, that's if you're a more longer term, gradual, bullish or bearish, that you think this is going to melt back up to 160 over the next 1 month or 2 months, not looking at September, but going out to October, going out to November, then yeah, you want to be out to January or December in those cases. But, and James says Apple will be fine. I know, but just as a general rule, if you're bearish on a stock, James, and you think it's going to fall back down in price, of course, just put in the value there and it'll show you here the best bang for your buck. Again, I'm expecting a decline. If I expected a decline, it's not a recommendation or suggestion. 15 points down to 135. 15 points roughly from where it is at, 13 points, excuse me, 14 points from where it is now. About a 10% decrease. That out of the money 140 put right now, probably with a delta of 0.25, is going to give you the best bang for the buck. The at the money is still going to be profitable. The 148, if I bought it, 149 put would still be profitable. But this is showing you the top 10, which will give you the best return if the stock hits that point at that price. Okay? And that's why, James, I don't have a direct answer for you. If I'm using a long haul as part of a calendar spread position or for a longer term hold, stock replacement, some call it, yes, I'm buying a 0.6 or 0.7 delta. If I'm speculating on only a 3-4% move in the next 30 days, I'm probably buying at the money, delta of 0.4 to 0.5. If I'm expecting a 10 or 15% increase or decrease in the stock, best bang for the buck is going very big. We're going out of the money. We're going 0.3 delta, maybe 0.25 with an out of the money, but it's based on the expectation of the decline that I'm expecting. The long option finder uses theoretical pricing models based on your expectations, investment amount, and target date. It is not a guarantee of profit if a stock moves up or down. Changes in implied volatility would alter expected prices. Unexpected movements could result in high losses or gains. Buying calls and puts is speculative and leverage. 90 to 100% losses of what you invest are possible. Options involve risk and may not be suitable for all investors, but it is a very powerful tool.